Everything you were taught about money before is incomplete. What you're about to hear isn't motivation. It's 67 years of financial mistakes distilled into one short video. If I could go back 67 years, I wouldn't work harder. I wouldn't trade more. I wouldn't chase trends. I would change just 5 decisions. Because the truth is simple. 90% of financial knowledge is just variations of the same 5 principles. And most people only understand them after it's too late. In this video, you'll learn those 5 simple steps, each one with massive impact on your financial future. Every step builds on the previous one, so listen carefully. Missing just one can cost you years. And if you want to learn more about money, investing, and long-term thinking, subscribe to Simply Money. Step 1. Invest in yourself first. This is the only investment with guaranteed long-term returns. Skills compound, knowledge compounds, your income potential compounds. Before stocks, before crypto, before real estate. If your income stays low, even perfect investing won't save you. Ask yourself, can you increase your income by 10 to 20% over the next few years? Can you learn a skill that makes you harder to replace? Can you communicate better, negotiate better, sell better, think better? Even a small income increase beats perfect investing with low income. Money doesn't flow to people who work the hardest. It flows to people who create value. And value is something you can learn. Step 2. Stop learning. This sounds wrong at first. You're watching this video. You probably watched dozens before this one. And it feels productive, right? Wrong. Learning without action is just comfortable procrastination. You don't need another video. You don't need perfect knowledge. You need movement. Instead, open a broker account today. Start investing now. Even if it's just 50 euros, the best time to invest was 10 years ago. The second best time is now. Knowledge without execution has a return of 0. Step 3. Opportunity cost. This is where most people lose without noticing. Opportunity cost means this. If you're not invested, you're actively losing future gains. Time is not neutral. 50 euros a month doesn't look impressive until compound interest starts working for decades. Small amounts plus long time beat big amounts plus late starts. Waiting feels safe, but waiting is expensive. And if you truly don't want to invest yet, at least park your money somewhere. It doesn't lose purchasing power. Platforms like Trade Republic or Scalable Capital currently offer around 2% interest. It's not exciting. It won't make you rich. But it protects you from inflation doing silent damage every year. Step 4. Risk is misunderstood. Most people think risk means volatility. It doesn't. Real risk is doing nothing. Cash feels safe, but inflation eats it every single year. And the scariest part is, you don't feel it day to day. It's silent, it's slow, but over years it destroys purchasing power. Here's what most people get wrong. When your portfolio drops 10% in a month, it feels risky. But when your money loses value slowly every year, it feels normal. That's why people panic sell during volatility and stay calm while inflation quietly wins. Risk is reduced by diversification. You don't bet your future on one company, one country, one sector, or one trend. Diversification is not about making more. It's about surviving everything. Long-time horizons. Time is the greatest risk reducer. Short-term price movement is noise. Long-term progress is the signal. The longer you stay invested, the more the market becomes predictable. Consistency. Most investors don't fail because they chose the wrong ETF. They fail because they stop. They quit when it's boring. They panic when it's scary. Consistency beats intelligence if intelligence is emotional. Trying to avoid all risk is often the riskiest decision of all. Wealth is not built by gambling, but it's also not built by fear. It's built by managed, intelligent risk, with rules, with discipline, with patience, over long periods of time. And here's the key. You don't need to be fearless. You need a system that works even when you're not confident. Because the market doesn't reward people who are always right. It rewards people who can stay calm, stay invested, and keep showing up. So if your goal is real wealth, not a lucky win, you don't avoid risk, you control it. And that brings us to the final step. Before the last and most important step, if this video is helping you, leave a like and comment your questions below. I read them, and they help the channel grow. Step 5. Cut your costs. This one hurts, but it matters more than most people think. Cut your costs. Not because you should live miserable, not because money is everything, but because leaks kill ships. Ask yourself, do you really need Amazon Prime, Netflix, Disney Plus, subscriptions you forgot even existed? Individually, they don't seem like much. Together, they quietly drain your future. And it's not just money, it's time. Time spent consuming instead of building. Time spent distracted instead of focused. Money can be replaced. Time never comes back. Every euro you don't waste is a euro that can compound for you instead of against you. These were 5 decisions. No secrets, no hacks, no trends, just fundamentals. The same ones people only understand after decades of mistakes. If you want to understand money properly, not emotionally, not impulsively, subscribe to Simply Money and check out the other videos on this channel. Because wealth isn't built fast, it's built correctly.